On July 21st, a specific tech stock closed up 7%. The next day, in pre-market trading, it climbed nearly 17%. Then, after hours, it surged another 15%. The company experiencing this massive wave of buying was Supermicro, or SMCI. They are a foundational hardware builder supplying the backbone of the modern tech industry. The trigger for this trading frenzy was a preliminary fourth-quarter financial update released on a quiet Tuesday afternoon. But the numbers looked bad. This diagram shows their estimated revenue target. Management announced that their actual revenue would land near the absolute bottom edge of their $11 to $12.5 billion guidance range. Under normal market conditions, missing the midpoint of revenue expectations is a major red flag. It usually triggers immediate investor panic and a swift sell-off. So why did investors smash the buy button when revenue underperformed? Because the market looked past today's top-line revenue to focus entirely on the quality and longevity of Supermicro's underlying AI engine. To understand the stock surge, we have to look at the first hidden metric Wall Street prioritized over raw revenue, a pivot in profitability. This breaks down Supermicro's previous financial guidance. For every dollar earned, investors expected an adjusted gross margin of just 8.2%. A company pulling in slightly less total revenue but keeping twice as much profit from every single dollar indicates pricing power in a constrained market. Profit margins were only half the story. The second metric that fueled the stock rally was the visibility provided by their order book. Comparing quarterly revenue to incoming business, Supermicro revealed a record-breaking backlog of new orders, exceeding $60 billion. This backlog results from a hardware arms race. Major cloud providers are expanding computing capacity, with orders delivered over future quarters. Combining high profit margins with a $60 billion backlog acts as a catalyst. It forced algorithmic and technical traders to quickly buy into the stock. This chart shows what trading algorithms saw. The stock price broke upward through its 20-day and 100-day simple moving averages, indicating improving near-term price action. However, facing resistance around 33.50, it needs to clear this cluster to confirm a sustained rebound. Ultimately, that $60 billion backlog gives the market a clearer look at future demand than we had previously. It suggests that despite the revenue miss today, the business has a substantial pipeline of orders waiting to be filled. If we zoom out from Supermicro's individual balance sheet, this single financial report acts as a diagnostic tool for the entire tech market. Financial commentator Jim Cramer analyzed the numbers publicly, noting that Supermicro's massive backlog provides a direct read-through to broader server demand. He explicitly named peers expected to benefit from this, stating that if Supermicro did that well, Dell Technologies should see strong results as well. These hardware companies provide the physical foundation for the AI boom. They don't need to build the best software, they just need to supply the metal required to run it. Which brings us back to our initial paradox. Supermicro's low revenue, high price surge suggests that the global AI boom isn't just a projection. It is a $60 billion physical reality, and the infrastructure build-out is accelerating.